With our variances for direct materials and direct labor out of the way, we can move on to our variances related to our company's overhead. And the variance for overhead is the difference between your actual overhead costs, so all of the costs that you paid for production, which weren't directly traceable to materials or labor, and the standard overhead allocated to production. Well, what exactly is that? The standard overhead allocated to production can be found by taking the standard overhead allocation rates, X amount of dollars per hour, or X amount of dollars per unit of your cost driver, and multiplying it by the standard quantity of your allocation base, your driver allowed for actual input. So if our driver is direct labor hours and it should have taken a certain amount of hours for each unit that we made, we just adjust that up to the actual number of units that we made. So for cheerful colors over here, what is their standards related to their overhead accounts? Let's start with variable overhead. Their standard is that it should be allocated at a rate of $3 per direct labor hour. What is their efficiency standard for variable overhead? Well, since their driver is direct labor hours, their efficiency standard should be how long it should take to make one box of crayons, since that's their driver, and that is 0.25 direct labor hours. Their actual amount of direct labor hours, as we've seen before, is 10,400, and their actual cost of variable overhead was $30,160. So if we go to find their variable overhead cost variance, which was $1,040 favorable, how did we get there? Well, we took the actual cost per unit of the driver and subtracted out the standard cost per unit of the driver. The driver, again, is direct labor hours. So if we go back over here, we see that we paid $30,160 as our actual variable overhead expenditures. The actual quantity of our driver was 10,400 labor hours. If we take that 30,160 and divide it by 10,400, that's how we come up with $2.90 per hour. So our actual rate that we were incurring variable overhead at was $2.90 per hour, less than the $3 per hour that we presumed in our budget, 10 cents less. And if we multiply that by the total quantity of our driver, or direct labor hours that we used, 10,400, we come up with a $1,040 variance. And since our actual costs were less than our standard that we set, that's good for our company. Less cost is always a good thing. So we have a $1,040 favorable variable overhead cost variance. For our variable overhead efficiency variance, we're going to take the actual quantity of the driver used, which was that 10,400 hours that we had before, and subtract out the standard quantity of the driver used that should have been used for the level of production that we did. So if you recall, we made 52,000 boxes of crayons. Our standard was to spend 0.25 hours making each box. 52,000 times 0.25 is where that 13,000 direct labor hours came from. That's how many hours it should have taken to make this level of production. Well, we spent 2,600 hours less making goods, which we were using as our driver for allocating out overhead. And if we take that 2,600 less hours and multiply it by our predetermined overhead allocation rate of $3 per direct labor hour for variable overhead, that's going to be a $7,800 variance. And this variance is going to be favorable because, again, if your employees can get the job done faster than you budgeted for, that's always good for the company. For fixed overhead variances, we are going to need our actual fixed overhead costs incurred, how much we budgeted for, and then we're going to need to determine how much we would have allocated during the period based upon our cost driver and our predetermined overhead allocation rate. So for the fixed overhead cost variance, it's very simple. Since fixed costs should not change with production levels, you don't need to go through all of the fancy actual quantity versus standard quantity, because that wouldn't change the level of overhead fixed overhead that you had. So to find your fixed overhead cost variance, you just take your actual fixed cost and subtract out the amount of fixed cost you budgeted for in your master budget. Cheerful Colors had $23,920 of actual fixed costs, less than the $25,000 that they set forth in their budget. So that $1,080 less in fixed costs that they paid is a very favorable variance for the company. The other variance that you have for fixed overhead is your volume variance. And the volume variance is the difference between how much you budgeted for and how much you allocated during the period. To find your allocated fixed overhead, what you do is you take your standard overhead allocation rate for that type of overhead. For fixed, we were allocating at a rate of $2 for every direct labor hour, and you multiply it by your standard quantity of the allocation base allowed for actual output. Fancy terminology. I'll break it down easier for you in a second. Our standard is that we are using direct labor hours as our driver, and each batch of cranes we make should take 0.25 direct labor hours. And we adjust it to actual output, the 52,000 batches of cranes that we actually made, and that's the 13,000 standard direct labor hours we should have used for our actual production. We multiply that by our allocation rate, and that would come out to 26,000. So to determine your allocated fixed overhead, essentially what you do is you take your actual production level and you multiply it by both of your standards for fixed overhead. And your standards are going to be your allocation rate, and your other standard is going to be the quantity of your allocation base or your driver that you should use for each unit. And in this case, our $26,000 of overhead, which we would have allocated during the period, is more than our budgeted fixed overhead, and the difference is $1,000, and it is favorable. And of all the things in accounting that it took me a little bit to wrap my mind around, it's why that would be a favorable variance. When we put more cost into product than we had budgeted for, how could that be favorable? And then I really thought about it, and the only time that ever happens is when your actual output is greater than what you budgeted for. And if you're making more units, well, that's got to be good for your company. So for fixed overhead volume variance, if your actual output is greater than what you had budgeted for in your master budget, you're always going to have a favorable variance. If your actual output, the actual number of units you made, is less than you budgeted for, it will always be an unfavorable variance. And with that, we have the entirety of our variances. As we see, we have a total of a $7,320 favorable flex budget variance, because in total for Cheerful Colors, their $303,680 of actual costs was less than what they should have paid in cost according to their flex budget, which is $311,000. Why? Well, they had a huge unfavorable variance for direct materials, but it was offset by the fact that direct labor came cheaper, their variable overhead was cheaper, and their fixed overhead was cheaper. So one cost component was a lot more, but the other three saved the company enough money that their actual amount of costs in the long run were less than they thought they would be at that level of production set forth by their flex budget. And here is the breakdown in chart form. Your total flex budget up on the top can be broken down into three different types of variances for your three cost components: materials, labor, and overhead. Within your materials and your labor variances, you can break them down for the portion of that variance which is attributable to a change in cost and the portion which is attributable to a change in efficiency. For the overhead variance, you can break it down between variable and fixed. And the variable overhead, again, can be separated into the portion which is attributable to cost and the portion which is attributable to efficiency. For fixed, because efficiency shouldn't matter, using more or less of your, making more or less units, I should say, the only portion of that you will have is cost.